introduction.
Okay.
Welcome to all participants. I want to say hello to everybody here. Maybe from the previous class, you know that we try to cover the expectation and market outlook for the 2024. Actually, we started to macro dynamics, GDP, inflation, current account, and budget deficit and employment market condition as well in the United States, the Federal Reserve and the developed markets. Then we pass to the emerging market economies for the macro indicators in global market updates for the 2024. Then we pass to the, rather than the real market, then financial market, the equity valuation, stock exchange, interest rate, what will happen to the interest rate decision for the next couple of months, especially after the second half of the 2024. Then we will try to cover today the fixed income securities update and expectation for the next year, actually this year. But the updates coming from the previous year. So during the presentation, you can write, Jamil Umer, I think you are trying to make a pencil on the screen, but I want to request from all participants that please don't touch your mouse while I'm reflecting my screen to the all participants, because I couldn't follow the presentation and slides in that way. If you have any type of question during the presentation, you can write all your questions simultaneously in the chat site. So even Dr. Lambert and all participants and me, at the same time, we can see all your questions and we will try to answer simultaneously those questions as well. But if you miss to write to your question, don't worry about that, because during the presentation, approximately in 10 or 11 slides, I'm trying to finish all those in approximately 45 minutes. Then I'm giving at the end of the class session the microphone to all participants that if they wonder any type of question in economics and finance, please be sure and keep in mind that not limited to today's topics. You can ask all type of question in economics and finance in the live classes during our presentation and while we are making the brainstorming at the end of classes. So I'm sure actually most of the participants knowing that what we mean by the fixed income securities, but for the whom they don't know what we mean by the fixed income securities, I will make a brief introduction and definition for the fixed income securities. In financial market, we have lots of different tools and investment strategies and investment tools as well. We can put our money in cash. You can bring your money to the bank as a cash deposit account. This is a cash. You can go to your stock exchange or the international market stock exchange, going to DAX in Germany, going to New York Stock Exchange or Dow Jones or Nasdaq in United States or Russell in UK. Whatever you want, you can bring your money in the financial market as an investment in stock exchange as well. In this stock exchange, what you can do, you can take a position in any type of firms, like the big firms, Apple, Amazon, Microsoft, or you can choose any type of commodity firms and the commercials to take the position. These type of things we call as equity investment or stock exchange investment. And lastly, we have lots of tools as well other than this, but lastly, we will focus on the fixed income securities. What we mean by fixed income securities, these are treasury bills and the government bonds, which is issued by generally the treasury of that country or the government of that country. So how we differentiate treasury bills and government bonds? Okay, what is the difference? Because normally both of them is fixed income securities. In fixed income securities, you should keep in mind that there is no risk. Okay, risk is only duration, the time you wait for that. But other than that, For instance, if you bring your money into the fixed income securities for this year, approximately, let's say the $1 million for this year, at the end of the year, without any risk, you will get your return with the fixed income securities interest rate. Let's say today, what is the 10-year treasury yield in United States? It's approximately 370. So for your $1 million, at the end of the year, you will get $37,000 without any risk. No volatility, nothing more. But if you bring your money in Amazon or Apple, $1 million, let's say the stock price of Amazon next year decreased 20%, meaning that you can lose approximately $200,000. Okay, these are volatility and their risks are really high. Their return also really high. Sometimes people double their money, right, in the stock exchange, even triple, even quarter. So in fixed income securities, you don't have risk. You will get your money because every government has a signature on the fixed income securities investment, and in any case of need, the government saying that this money, this issues, these bonds or bills will be paid for the investor at the end of the maturity. Okay, this is a guarantee from the government. So if the fixed income securities is two types, treasury bills and government bonds, what is the basic difference between them? Because normally both the, let's say the US Treasury or Turkish Treasury or France Treasury issues the treasury bills and government bonds. But what is the basic reason behind that? Both of them is fixed income. The basic difference is coming from the maturity. Okay, maturity means if the fixed income security is short term, meaning that the maturity will be covered in 1 year. So if you take a position and it will mature in 1 year, this is a treasury bill. Okay. But if the maturity is more than 1 year, especially 2 or 10 years, this is government bonds. Okay. So when anybody else on the street asks you what is the difference between the treasury bills and the government bonds, both of them are the fixed income securities and there is no risk on their issues, you can now directly say that the only difference between them is the maturity of them. Okay, maturity in treasury bills is less than 1 year, and maturity in government bonds generally greater than 1 year and generally is approximately 5-10 years. Now, I will try to reflect what is happening in all around the world, even in developed market, even in emerging market, and even the mixture of them in different regions of the countries and the world, what is happening in fixed income securities investment and what the market makers is expecting the global scenarios about the fixed income securities all around the world for the 2024. During 1 year, what is priced in expectation and what can be happen probably in the fixed income securities market. Okay, Dr. Lambert, thanks for that. He's also writing directly what is happening here, and in chat side, if you couldn't understand and couldn't follow, maybe you can join the presentation. Maybe after you missed my words, you can follow what is their difference, especially in the chat side. Dr. Lambert directly writing simultaneously all of them. Thanks for that.
I was going to wonder, are you going to be talking about if somebody tries to buy US bills and bonds with their own foreign currency?
Exactly.
Okay, this is going to be good.
All we are speaking here, not the domestic treasury bills and government bonds, the international market. For instance, Turkish treasury bill today is approximately 48% in two-year treasury bill. But when the Turkish treasury put a euro bond in the international market, the real return is just 10%. 10% in United States term. Okay, United States dollar terms. The 48 is in Turkish lira. So we are not speaking domestic currencies. We are just speaking now all the currencies is converted to United States dollar, and we are speaking all the international market fixed income securities, not the domestic. Okay. Now, here our slides. Let's start initially and gradually from the fixed income yields. As you see in the charts, the blue line, please focus on this side right now. Focus on only this side. Here we have Japanese 10-year, German 10-year, UK 10-year, Italy, and US. What we mean by this, these are the best well-known developed market economies in all around the world. And one of them is a little bit risky. The Italy one is risky. But the US, UK, Germany, and Japan Treasury yields, as you see here, Italy is 0.3. By the way, you should always keep in mind that. You should always keep in mind that. I say this 2 times because this is really critical and important. If the return, let's say, today, the 10-year Treasury yield in United States is 3.7. And if you buy the 10-year government bonds in United States with 3.7, and if the rate increased to 4, is this good? No. If the return in government bills, if the interest rate in government bills is increased, the price of the government bond decreased. Always please keep in mind this issue. Price and interest rate has a negative correlation between them. So if the interest rate in government bond increasing, meaning that its price is decreasing. So if you take position in 3.7 here, and if the interest rate go to the 4%, meaning that your $1 million will decrease approximately $950,000. You are losing money if the interest rate increasing. So directly you can look at the 10-year Treasury yield return in all around the world, and you can directly say that which countries are risky. Because if the countries offer you a greater increase in their interest rate, this means that your return can be lower. So as you see here, 0 in Japanese 10-year, 0 in UK 10-year, US is minus, Germany is minus, but Italy is positive. Why? Why Italy is positive? And why Japan or UK is 0 and Germany and US Treasury yield is 0 or minus? The basic mind is this. Let's say Dr. Lambert is today the head of Treasury in United States, and United States need money, okay? Because they have lots of government expenditure. So I should issue a bill, sell to this investor, take the money and finance my all type of government expenditure, infrastructure, electricity, ways, highways, everything. I need money. I'm giving the Treasury bills to the investor and I'm taking the money from them. Then in each period, I will pay their money back. Okay, at the end of the maturity, they will give the bill to me and they will get their money. This is the basic logic. So why the increase in interest rate showing a risky asset in that country? Because of this. If Dr. Lambert offered 3% as the United States Treasury had, and if he see that nobody is buying their Treasury bills, Dr. Lambert understand that investors see this 3% return is not covering their risk while they are making investment. So he will increase the interest rate. Okay, then he will offer to the investor to 5%. So you can ask this, Dr. Kadir, a few minutes ago you said that in domestic currency, Turkish 10-year Treasury bill is approximately, let's say, 40%. But in United States term, if you issue a 10-year Euro bond, meaning that it is returned in United States dollar, it is 8%. So if the Turkish Treasury return in United States term is 8%, why the US or Germany term is 0? Both of them is in United States term. Why it is 0 and Turkey is 8? Because Turkey couldn't find any investor with 0% in all around the world, because investors saying that I can get all my money without any risk in Germany or United Kingdom, even with zero return. But even you offer 10% return to me, one bird at hand is better than 100 bird at the tree. Okay, because I even couldn't get the money from Turkey or South Africa. There are huge risk in those countries, political risk, election risk, war risk, everything. But even the United States over 0%, I will bring my money to the United States. For that reason, if I couldn't find the suitable investor, I should offer them to high interest return to make their risk appetite increasing. Okay.
So Abdulkadir, so when you buy, say, let's say there one's like $100, right? $100, they put it on the market. And so if they want to raise that interest rate, they just lower the price on it, right? And then that interest, and then the interest rate that you would return would rise because the price is lower, but that return is fixed.
Exactly. So let's say why today's topic all around the world is fixed income securities is offering a better return for the next year. This is because of this. After the Federal Reserve Fed increased their interest rate, their 2-year and 10-year Treasury bill is approximately 4-5%, right? And these rates never seen an unprecedented rate after the global financial crisis of 2008. After that, only one time US 10-year Treasury bill reached to the 5%, it is COVID crisis today. So investors knowing that the 5% is the peak of the 10-year Treasury, right? 5% is peak of the 10-year Treasury. So if I get position with 5%, $100, Federal Reserve 10-year rate, 5%, will decrease gradually because I know that this is the peak level. So if the interest rate decreasing, my $100 will increase because my price will increase. Okay, this is the basic logic. So if somebody brings the money here, they want to decrease in interest rate. If the interest rate decrease, their return will increase in United States or domestic currency. But if the interest rate increasing, meaning that risk is increasing, everybody melting and capital outflowing happening in this country. So I will lose the money. This is the basic standards in foreign exchange market, fixed income securities, interest rate and price of the bond. Always keep in mind, interest rate and price of the bond has a negative relation. If the interest rate is increasing, price of the bond is decreasing. Okay, if the interest rate decreasing, price of the bond increasing. So if I buy here with 5%, $100, and if I know that Federal Reserve interest rate will decrease gradually, my price will increase gradually, and I will get a net profit at the end of the year. This is the basic reason.
So are you saying that when interest rates are low, that's the time that you do not want to buy bills and bonds?
Exactly.
And if interest rates are high and you think they're going to be coming down, then buy the bills and bonds.
Exactly. For instance, Dr. Lambert, one of my clients all around the world request from me that write a 3-page paper what happened in 2021, 2 years ago, in United Kingdom pension fund. What happened there? Pension fund are long-term investors because they never put money in stock exchange or short-term yield, because pension mean long-term yield, because pension means you will retire, long-term perspective in this investment. Then all the money, almost all the money, 90% of the pension fund collection and premium collected, then put to the long-term government bills, 10-year, 30-year Treasury bills. Then after the COVID crisis, when the interest rates started to increase from 2% to 5% in United Kingdom, pension fund approximately lost 30 billion pounds during 1 year because the interest rate increased. Then United Kingdom Bank of England come to the intervene the market, buy lots of government bills, meaning that if I buy the government bills, I will increase my demand and their price will increase, right? If I increase my demand, their price increase. Price increase, interest rate decrease. Because of the pension fund lost 30 billion pounds in 1 year because of the interest rate increase, then the Bank of England come to the market to decrease this interest rate. They bought lots of long-term treasury bills and government bonds in the market. Okay, any type of increase in interest rate will be a hell for all investors in fixed income securities. So if you put your money in fixed income, long-term yield, you should be assume that at the end, this will be the peak level for the interest rate for your fixed income. If there is a probability to any more increase, this means that you will lose the money. Now, at the left-hand side, as you see, these are the developed market bonds. Please look at the rates. And these are the investment grade bonds. So, for instance, Apple bonds better than the South Africa or Russian bonds, even government bonds, because Apple is more profitable and more robust than the Russian government, right? Because Russia has a huge risk, but Apple is not. So investment grade bond is also really low return. Please look at this: Euro, global, US, UK, and UK. These are investment grade bonds, and as you see here, the return is also so lower. And the high yield bonds. What we mean by high yield bonds? High yield bonds, like a crash bonds and hedge funds generally take position on this type of things, because bonds does not mean directly issued by the government. Sometimes both bonds can be issued by the corporate sector as well, and those type of bonds can offer you a higher return, and these are the high yield bonds, less than the higher risk than the government bonds and higher return than government bonds. So government bonds, lower return, lower volatility. High yield bonds, higher return, high volatility. Okay, these are generally corporate bonds. And here we have the emerging market bonds. Please look at the emerging market: China, corporate, sovereign, and the local. So emerging market bond is generally higher than the government bonds and lower than the high yield bonds. Okay, because these are the government and these are just the corporate. You should keep in mind in this type of things, first, for instance, if you open a position in the deposit account in your bank, and if your investment advisor say that you have $1 million, let's divide this risk management into 3 parts, and let's take the position in government securities, fixed income, stock exchange, equity, and let's say put the term deposit 40%, 30%, and 30%. Then your investment advisor asks you this question: how much money you can lose and tolerate at the end of the year? If you say that I can tolerate from $1 million approximately $300,000 loss, then they can say that let's put money in equity. But if you even can't tolerate from $1 million, $10,000, you shouldn't enter any type of financial markets. Okay, you should put your all money in term deposit and cash. Just the interest rate return. Because if you don't tolerate $10,000 in 1 year, if you put your money in equity, you can lose that 10,000 in equity market in just 30 minutes. Okay. So first of all, you should ask yourself that if I want to take a position in financial market, am I a risk aversive, risk neutral, and risk loving person? If I'm a risk neutral, I can take position. If I am a risk loving, I can take higher position. But if I am a risk averse person, I should never take a position in stock exchange, in hedge funds, in financial leverage markets, because you can even lose all of your money in leverage. If you are, first, you should close your eyes and ask yourself that, what is my risk perception? Okay. Then, according to your risk perception, your investment advisor guide you and put your money in different baskets. And in my second slide, as you see here, I have government bond yields all around the world. This is global government bond yields. And the left-hand side showing that nominal 10-year government bond yields. Nominal. What we mean by nominal? This is directly Treasury bill, and I see the prices. This is nominal. What is real? If I subtract from the nominal yields the inflation rate, price changes, this is the real return. Okay, so the basic difference between nominal and real is this. If I see a direct number on the screen, this is nominal. Then from that nominal yields, if I decrease the inflation to this country, this will be my real return. Okay, so nominal and real difference is the inflation rate. So if you see here the nominal 10-year government bond yields, this is the direct head numbers of the 10-year Treasury bill on the screen. And as you see, the black line is the United States, the blue is the UK, purple is Eurozone, and the green is the Japan. So what happened here? COVID crisis. During the COVID crisis, all the developed markets, central banks decreased the interest rate first to trigger the inflation and consumption. Then, when they see the inflation is necessary for their target, they started to do quantitative tapering process in all around the world and started to increase the interest rate. For instance, Federal Reserve start from 0 and reach to the today 5.5%. So if my short-term rates increase, then my 10-year Treasury yield also increased to until 5% as well. So what is the difference in the Japan? Why the Eurozone, UK, US, France, Germany, everybody 10-year Treasury yield increasing, but why it is so steeper in the Japanese economy? Because Japanese economy, approximately during the 30 years in the stagflation or recession period, what we mean by this, they couldn't produce inflation in any type of measures. They are decreasing the interest rate. They are giving lots of incentive in monetary and fiscal policies. They are decreasing the tax rate. They are doing everything. But the inflation is not triggering in these countries. So if the inflation rate is lower, meaning that after even 10 years, I have positive real return. For instance, why the rate is higher here? Because everybody else know that I have today 5.5% return in 10-year Treasury and government bills. But if the inflation expectation 10 years later increasing, I will increase my 10-year yield today as well. Because investor will know that after 10 years, yes, I will get 5%. But after 10 years, inflation, if become 12%, I will lose the money in real return, right? So their expectation in yields will increasing when the inflation expectation is increasing. But Japanese economy never increase their inflation expectation. Whatever they do, they put monetary policy, they put fiscal policy, they put lots of government intervention to the market, but inflation expectation is not increasing. So their yield curve is so steeper like this. So their 10-year Treasury return is just approximately less than 1%. It is in 5% in the United States, but it is just 1% in Japanese economy. So if somebody else is asking you, what is the difference, basic difference in financial market of the Japanese economy rather than the other developed financial market economies? This is the basic reason. Japanese generally in recession, they couldn't increase their GDP growth. They couldn't increase their inflation rate in any type of measures. So their yield curve is so flat like this. not increase, not decrease, and no risk in this country also, no risk. You can get what you put. And here, this is the real global government bond yields. Here we have differentiated it according to the region, but here we are taking into consideration all around the world, all countries, all regions. And today, as you see here, during the COVID, first, the central bank decreased the interest rate to trigger the inflation, to trigger the economy, bring the unemployment rate less than their target level. They first decreased the interest rate. And after here, they started to increase their interest rate and to fight with the inflation. And today, all around the world, if you take a measure and an average of the weighted average of the global economy is 10-year treasury yield, it is approximately 2%. And this is normal. So when you take the average of this approximately 20 years, you will find that it is almost around the 2% as well. Today we are around the 2%. But for instance, come here and come here. For the United States, approximately 20 years ago, we only see 5%. And after that, we will never see 5% for the United States, only today. So, as I said, this 5% is almost the peak level for the United States 10-year treasury yield. So I can take the position because I know that interest rate will decrease and my price will increase. I will get positive return. Okay. Now, this is the yield curve. United States yield curve. Yield curve means in what maturity I will get different yields. Okay, let me share my screen about the yield curve and you will understand how the yield curve will be seen. Hang on a sec. If I can open my screen. I will share the yield curve shape, then you will understand that how the yield curve will seen in the financial market. Okay. Yield curve is this. Please look at the screen. Can everybody see my screen of the Bloomberg in the yield curve?
Yes.
Okay, perfect.
We see the green curve, right?
Yeah, exactly. This is the green curve. Please look at this one. As you see here, this green curve is approximately in the December of the Turkish government bond yields. Here the maturities, 3 months, 6 months, 1 year, 2 year, 3 year, 4 year, 5 year, up until the 10 year. And these are the return. Okay, so in 3 months, it is offering 38%, but in 10 years, it is offering just approximately 24%. And this curve is like this dash line. Please look at this dash line, upward sloping. It is in June. What we mean by this? In June, all investors expecting that Turkish inflation will increase in 10 years. So I'm increasing my expectation in 10-year return. So if I buy the Turkish bonds, Turkish government should bring my money in this style, upward sloping. In 3 months this, but in 10 years is this. But after that, when the Turkish central bank started to increase their interest rate in each monetary policy meeting 500 basis points, then the return and the shape of the yield curve will end downward sloping, meaning that in 3 months they can offer 38, but for the 10-year treasury it is just 24%, meaning that in 10 years inflation will decrease and you will get the real return, positive real return. Let me turn my standard slide. Here it is. US yield curve. As you see, the US yield curve here. And the definition is here. As you see here, the definition is basis point 10-year treasury yield minus 2-year treasury yield. What we mean by this? I'm taking a spread between 10-year treasury yield and 2-year treasury yield. So if this is positive, if 10-year treasury yield is greater than 2-year treasury yield, this means that this number is positive, and 10 year is higher than 2-year. So I'm expecting that 2-year later inflation will be less than 10-year later inflation rate. I'm expecting an increase in the inflation rate in the long run. So 10-year yield will be higher than 2-year yield. So if the inflation is good, meaning that GDP will be good, economy will be good in the long term. But if the short-term yield, meaning that short-term yield is here 2-year treasury yield, if this short-term yield higher than the long-term yield, this number 10-year minus 2-year will be negative, right? Because short-term is higher, 2-year is higher than the 10-year. If this number is higher than this 10-year treasury yield, this number will be minus. This meaning that in short term, inflation will be higher, but in the long term, it will be decreasing. So this is a signature of the recession. Please look at this. This gray dash line here, the columns are the recession period in the United States. Here, 1980s recession, dot-com crisis, internet bubbles, 2008 financial crisis, and global COVID crisis. And in each of them, when the 10-year to 2-year spread converts to zero, look at here, zero, look at here, zero, zero, and zero. If this difference spread converts to zero, after in 1 year, we always see a recession. Here, the difference is zero and the recession here. Here, difference is zero, recession here. Difference zero and recession here. Okay, so why we are always speaking about the recession on the 2024? Because we are here. The spread is zero. So in next couple of months, all people expecting a recession from the historical experience here, here, and here. When the difference between the long-term and short-term yield converges to zero, meaning that next year, most probably we will experience a recession in the economy. Okay. And here we have US Treasury diversification panel. This is S&P 500 divided by, I'm taking a relative performance of the stock exchange, S&P 500, to the US 10-year Treasury correlation, meaning that rolling 1-year correlation based on weekly return. So I'm taking the weekly return and rolling it for the 1 year, accumulating it for the 1 year and counting the number in rolling basis for the yearly year of change. As you see here, the correlation between the S&P 500 and US 10-year Treasury yield between 1980s and 2000 is approximately 40% correlation. Meaning that if the 10-year Treasury yield increasing, S&P 500 also increased during this period. Then, during the 2000 in millennium years, S&P 500 and US Treasury yield always in a negative relation. And today, we have a dramatic curve like in 1980s. Both S&P 500 and the US Treasury yield is increasing. This is not normal. Normal period is here. Because if the interest rate increasing in Treasury yield, everybody put their money in fixed income and take their money from the volatile and risky asset in stock exchange. So if the price of if the US 10-year Treasury yield decreasing, S&P 500 should be increased or vice versa. They should have a negative correlation. So we are not in normal periods here. And this will be converged to this side. On the right hand side, the total return scenario for US Treasury, these are bips. We are saying basis point. Basis point mean 300 over 10,000. Okay, you can always think that BPS is basis point. Basis point meaning that this number over 10,000. Okay, you can direct, or if this is 300 basis percent, meaning that 3% only. Because if I divide this number to 10,000, this 20 gone, then the denominator converges to from 10,000 to 100. So 3 over 100 means 3%. You can think either way. 300 basis point meaning that 300 over 10,000 or just 3%. And here, as you see, we have yield change over the next couple of months. Here, 2-year, the black column, and the 10-year is this one. And here we have total return scenarios. So scenario is saying that here, 10-year treasury yield is at most decreased 20%, but it can increase approximately 27%. Their return, okay? Meaning that the decreased scenario is less probable than increased scenario. So if I take an equal opportunity, my return in high increase in my yield is approximately 27, and my loss is 20%. Even in this case, I have 7% positive return because I know that treasury yield is in the peak period. As you see here in 2 years, in the short term, it is better, 9% positive, and there is even no probability of losing the money in short-term yields. Okay, meaning that in short term, all the interest rate will decrease and your price of government bonds will increase. Okay, in short term, no recession probability, no risk of losing your money in government bonds and treasury bills. Global fixed income spreads. What we mean by spread? We mean by spread is this. Normally, lots of countries, while counting their risk aversive or risky outlook, they generally take the spread of the return. So if I take the Turkish government bonds spread from the United States, what is it today? Turkish government United States bond style is 8%, and United States 10-year is just 3%. Today, spread is 5%. So if this spread is increasing, the risk for Turkey is increasing. For instance, in international market, you will see lots of times German bond yield spread from Italy, Greece, Spain, and Ireland. Why? Because we see a euro crisis in these countries: Ireland, Spain, Greece, and Italy, right? In 2010, we see a euro crisis from those 4 countries. And how those countries has a risk perception in international investor perception style, we directly say that we are taking the spreads for those government bonds from the Germany, because Germany has zero risk. Germany has no risk. If the spread of the Italy with Germany here, let's say 3 basis point, then next year, if it is 5 basis point, meaning that risk in Italy is increasing. Okay, you should always, because Germany has no risk. If the Italy spread is increasing, risk in Italy is increasing. If the spread is converging to Germany, meaning that there is no risk in Italy. Okay, spread is this. How risky you are when you compare it with riskless asset. Because Germany, United States has no risk. If the spread between those countries and you is 0, you have no risk. If your spread is increasing, your risk is increasing. I have lots of questions. We have, yeah, I think Dr. Lambert always helping here. There are lots of WhatsApp numbers. I'm focusing on the slides, but as you see here, fixed income spreads between the countries, as you see here, in the high yield is higher, because high yield is high risk. and its spread is really high. But when you go to the investment grade of the United States, there is no spread because it is almost no risk, no return, zero return, zero risk. But the high yield bonds, this is high yield bonds, they are offering high yields. So their spread will be high because they have risk. And here we have corporate refinancing, global credit maturity schedule. On the left-hand side, investment grade and high yield bonds. Normally, investment grade has lower return. High yield bonds has higher return because they are higher risk. And here, from here to here, high yield bonds has peaked approximately 19% in 2028 and almost greater than the 15% during the 6 years. But the investment grade bonds almost around 10% during the 6 year and the lower volatility. And when I look at the right-hand side, interest cost of increasing when refinancing, meaning that if the interest rate increasing, my cost of refinancing will be increased because I should pay more money to my investor. Initially, I'm taking their money first. I'm giving my bonds to them. And if the interest rate increasing, the price of the bond decreasing, they are losing the money. But because of I pay my money back to investors, they will get higher return and I will pay higher cost of financing for my investor at the end of the maturity period. And here we have high yield bonds. As I said, high yield bonds is not investment grade. They have huge volatility and risk, but because of their risk, they have higher return as well. And on the left-hand side, we have US high yield spread and default. Default mean what is the probability that you don't pay this money? Okay, bankruptcy, default, a probability of default, meaning that you don't have capacity to pay this debt, default. Okay, you are not paying. And the default rate and the option adjusted spread. As you see here.
Abdulkadir, a question.
Yes.
So if you live in a country with high inflation, you're tempted to take those high yield bonds, right?
Yes, exactly.
Is that a trap?
Exactly. Normally, if the inflation rate in those countries, generally those countries' bond yields are generally high bond yields. They are not investment grade because they are risky. Nobody is bringing money to those countries because let's think this, Dr. Lambert. You are taking $1 million to Turkish market in May. Okay, I'm just making a basic calculation. In May, the exchange rate for Turkish lira United States is 19. Okay, 19. I bring my money. I put my money in investment 10-year treasury bond or 2-year treasury bill. Then during 8 months from May to here, let's say, what is the 10-year treasury bill return for 1 year? It is for Turkish market, it is approximately 25%. Okay, so in 8 months, I will get approximately 16%. This is right. Okay, I'm putting $1 million and putting here 16%. But today the Turkish lira United States exchange rate is approximately 31. So when I bring my money to $1 million and convert into Turkish lira, it is 19 million Turkish lira. Then I put this 19 million, let's say 20 million, 19 million. 19 million with 8-month return, 16% return. This is approximately 2.5 million. Okay, 2.5 million return. Then I'm adding this money, 22 million Turkish lira I have at hand. And I'm supposing that I get the money because I bring 19 million and now my money is 22 million. But I don't want to consume this money in Turkey. I want my money back to the United States. So nobody needs Turkish lira in the United States. So I should convert my money again the United States dollar. What is the United States dollar today? 31 lira. And I have 22 million. If I convert this money, my money is $900,000. At the beginning, I bring $1 million. I get return. Then I have just $900,000. I'm losing money because of the exchange rate risk, because of the inflation risk, because of the country risk, because of the political risk. So nobody bring these type of countries any type of money because of the risk outlook. Okay, this is the basic structure in the international finances. This is US high yield at the left-hand side, and here we have on the right-hand side the Euro high yields. This is Euro crisis, and this is global financial crisis, and this is the COVID crisis. Same here, 2000.com crisis, 2008 global financial crisis, and 2021 COVID crisis. As you see, option prices in the blue line, that spread is here, and spread is increasing because especially in crisis period, high bond yields, meaning that will reach an extraordinary return because there's a crisis period. But the default rate will around just 4% for this country, or for Euro, it is just 2%. Equity and bond return after the Fed hiking cycle. This chart is important. Why? Because in S&P 500, as you see here, when I started to increase my interest rate, as you see here, we are here, and we have different type of period, 1994 and 95, 1980s, 2015, 1988 and 1999, 2004 and 1999 and 2000. These are different time periods for the 12 months forward and 24 months forward and 12 months back. These are showing what will happen the S&P return. And S&P return, as you see, after the Fed started to increase the interest rate, this is the last hike, okay, last hike. After this, S&P return increasing. Why? We speak this a few minutes ago here. We said that if the interest rate increasing, S&P should be decrease, or vice versa. If the Fed decrease interest rate, S&P will rise. They have negative correlation. And come here, if this is last hike, meaning that from here, I will decrease the interest rate, right? So if the interest rate decreasing, S&P 500 return will increase. Okay, because if I put my money to the cash, its return will be lower. So I want higher return. I'm going to S&P 500 and getting higher return. If everybody do the same, S&P 500 return is increasing because interest rate decreasing. Okay. Alternative investment. And here, US 10-year Treasury at the end of Fed hiking cycle. As you see, this is return, not the interest rate. When I put last hike here, Dr. Lambert, this is for exactly for you. This is the last hike, meaning that here I have the peak of the interest rate of the US 10-year Treasury, meaning that my return, my gain, and my profit will be higher for this fixed income after this period because I'm here in the peak of the interest rate. My return will be higher in the next periods.